The spotlight on BEML. There have been recent order wins. What is the outlook when it comes to their order book and revenue targets? Shantanu Roy is the chairman managing director now joining in. Mr. Roy, good to have you on board. Given that we have seen strong traction in defense and rail and metro orders over the last few quarters, and even the potential over the next 2 to 3 years looks promising. What is the kind of revenue that you're targeting? Is 7,000 crores in FY26 on track?
Yes, more or less it seems we are on track. And, in defense, there is a lot of traction, definitely. And in rail metro, yes, we are depending upon some of the orders that we are expecting to be finalized in the metro sector, as well as in the rail sector. So definitely we'll be on track with these.
Right. Mr. Roy, your order book is currently at 12,800 odd crore rupees, right? Break it down for us in terms of how much contribution comes in from rail and metro, defense, mining and construction.
On date is 12,800 crores. We have just secured the 3,100 crore order for the Bangalore Metro rolling stock. And there the breakdown is basically around 60% of that order book is rail and metro, 30% is in defense aerospace, and 10% is in mining and construction. Now, mining and construction, why it is 10%? Because generally the orders start flowing in from the third quarter. And generally it's a fast moving product. So we are able to deliver in a span of 5 to 6 months. So whatever orders we'll book by October, we'll be able to liquidate the same by March 2024.
What is the worth of the orders that are imminent in the defense and metro projects, and what is your targeted order book?
For the current year, we have already booked around 5,000 crores of order since April of this year. And we expect to book another 7,000 to 9,000 crores of order by March 2024. So that we'll end up with around 17,000 crores of order book as on 31st March 2024, provided we are able to achieve a sales revenue of 5,000 crores this year.
Right. But can we see rail and metro as well as defense projects, which are higher value and require less manpower? So, I mean, will margins improve here then?
Yes, definitely we can expect that our margins will improve, riding on the bigger share for the defense and rail and metro orders, more specifically on the rail orders, because metro is again, the margins are very tight. There is a lot of competition in the market, but as far as rail is concerned, yes, we can expect better margins.
Now, your employee cost as a percentage of revenues is quite high, around 21.5% in FY23. And despite trending downwards in the recent years, do you think that it can come lower even further? And if so, how?
You see, the employee cost as a percentage of revenue was quite high some 3-4 years back. Now we have brought it to at a level of around 22%. And basically, one thing is that our revenue, as it goes up, the employees also, the number, it will go down because of natural attrition. We will have a reduction in the number of employees by at least 25% in the next couple of years because of their superannuations. But at the same time, we'll be recruiting also to fill in the gaps in our skill sets. So I believe in absolute terms, maybe the employee cost may go up, but as a percentage, it will be at around 20% of the revenue in the next couple of years. We'll try to maintain it around this and maybe even lesser than this.
Sure. Mr. Roy, you're guiding for a 200 bips plus EBITDA margin increment in FY24. What do you think is going to drive this growth?
You see, we have had a regular growth in EBITDA over the past 3 years. And in terms of percentage, now we are almost hitting the double digits. Now the growth in EBITDA will be again guided by, number one, our higher share in the defense vertical, our higher share in the rail vertical, as well as our efforts at bringing down the cost, rationalization of design, restructuring the manpower, restructuring the resources in the company, and of course, working on various other strategies of growth and bringing down the cost, as well as a complete focus on quality.
What is the outlook on the orders in defense and aerospace and the further orders after the completed negotiations for HMVs and command post vehicles?
Our expectation is that by say next to next year, we will have an order book of defense in aerospace almost to the tune of 7 to 8,000 crores, and which will make at least 50% of our total order book. That is what our expectation is for the next couple of years.
Right. Mr. Roy, lastly, the 200 crore rupee capex which you've planned in FY24, which is high compared to your previous 50, 60 odd crore rupees levels. What is this capex specifically for?
The capex in terms of percentage is almost 5% of our revenue, and that is being used mostly to generate our capability to handle overhauling of some defense vehicles, plus developing a capex for augmenting our rail and metro facilities, plus capex which will be used for developing our capabilities for further strengthening our core areas in defense, like the armoring. Apart from that, we are also infusing capex in replacing old machines with newer machines having a high level of IT or Industry 4.0 in that. We have also introduced Industry 4.0 on a pilot basis, and we expect that we will invest more in such practices so that the best in-class manufacturing facilities can be created in BEML.
Okay, let me also welcome on board Mr. Roy. Firstly, thank you so much for taking the time out and joining in.